Welcome everybody, and thank you for joining us for today's presentation. My name is Mark Feiner and I am the chair of the tax group here at Murtha Cullina. I'm joined today by my partner, Mark Tarallo, of our Business and Finance Department in our Boston office. Today we'll be talking to you about the Paycheck Protection Program with a focus on loan forgiveness. First, I'm going to take a couple of minutes to go over a couple of housekeeping items. All callers are currently in listen-only mode. If time permits, we will answer any questions submitted towards the end of the program. So if you'd like to submit a question, please do that in the chat box, and if time permits, we'll address as many questions as we can, and those we can address, we'll get back to the person asking the question. The webinar is being recorded, so all of today's participants will receive an email following today's presentation with the PowerPoint slides and a link to the webinar recording. So let's begin. So first we're going to start with an overview of the Paycheck Protection Program. Next slide, please. So on March 27th, President Trump signed into law the Coronavirus Aid, Relief, and Economic Securities Act, which everyone calls the CARES Act. And under the CARES Act, appropriated $670 billion for small businesses to obtain loans through the Small Business Administration through a program called the Paycheck Protection Program, affectionately known as the PPP by most people. And qualifying businesses could apply for PPP loans up to 2.5 times their average monthly payroll with a cap of $10 million using payroll data from either the 12 months immediately prior to the date of the loan application or payroll information from the calendar year 2019. And the PPP loan proceeds can be used for qualifying expenses. And qualifying expenses under the program include payroll costs, including costs related to the continuation of group health care benefits and insurance premiums, utility payments, lease and rent payments, interest on mortgage obligations, and interest on any other debt incurred prior to February 15th, 2020. And PPP loan forgiveness is available to the extent the loan proceeds are used to pay eligible costs for the first 8 weeks after receiving the loan proceeds. So essentially, once the loan is dispersed to the borrower, the 8-week clock begins to tick. All PP payments are deferred for 6 months, and PPP loans are non-recourse, meaning there's no collateral required and no personal guarantee of the borrower or owners of the borrower are required. If you could move to the next slide, please. Next slide, please. No, you went. Slide 5, please. Eligibility for PPP loans was based on an employee size standard, a revenue-based standard, and an alternative size standard. Generally, businesses with up to 500 employees or which meet an applicable employee size standard for a relevant industry were considered small business concerns under SBA regulations. And to determine that, businesses would need to look at their industry code under the North American Industry Classification System and determine whether the number of employees the business had qualified the business for as a small business concern. Businesses could also qualify on a revenue-based size standard, looking under the same code within the North American Industry Classification System chart. And lastly, businesses could be eligible for SBA PPP loans under an alternative size standard if they met the standard as of March 27, 2020. And that standard required businesses to have a maximum tangible net worth of less than or equal to $15 million, and a business's average net income after deducting federal income taxes for the 2 full fiscal years prior to the application date to be less than or equal to $5 million. Exceptions were made for businesses in the food industry and the accommodation, for example, hotel industry, with more than one location, but not more than 500 employees at each location. Certain nonprofits are eligible for PPP loans, and certain independent contractors, self-employed individuals, and sole proprietors are eligible for PPP loans. And in determining whether the business or borrower is eligible, the borrower needs to be cognizant of the SBA affiliation rules, which apply to determine loan eligibility under the employee size-based, revenue size-based, and alternative size-based standards. And those affiliation rules apply to affiliations not only of domestic entities, but domestic and foreign affiliates. Next slide, please.
So this is Mark Torello. I'd like to welcome everybody and thank you for attending. I do want to point out that if you go back to the beginning of the presentation and you see that picture of Mark and I looking all neat and tidy in our suits, 8 weeks into the lockdown, we don't look anything like that anymore. I just wanted to make that very, very clear that those pictures were taken some time ago. So I'm going to talk a little bit about the forgiveness aspects generally. Obviously, that is a feature that made these PPP loans very attractive to a number of borrowers. The idea that ultimately, if you spend the money on payroll and a certain amount on other allowable expenses, the full amount of the loan would be forgiven. The maximum amount, and actually, let me just step back for a second. We're going to talk a little bit more in detail about the application now that it is out. One of the features, one of the items on the application that you have to fill in is the maximum loan forgiveness amount, which is going to be capped at the principal amount of the loan. This is still an open question. This deviates from some prior guidance that suggested that accrued interest would be included in the forgivable amount, but on the form itself, it doesn't provide for that. Now, again, we've seen guidance coming out very frequently on these, so this may be a situation where more guidance is forthcoming, but right now, the maximum amount that is forgivable is the principal amount of the loan, so the interest is going to be an open question. The forgiveness is going to be determined by the lender, not the SBA. So there is a very good possibility that the lenders are simply going to forgive the interest on a number of the promissory notes that I looked at early in the process. It didn't mention any type of forgiveness or give any guidance on that. So again, I think that's still going to be an open issue, hopefully one that gets further clarified as we move into the process. So generally, what is forgivable? What is forgivable are the amounts that you incur or pay for payroll costs during an 8-week period, which is sometimes referred to as the covered period or the covered forgiveness period. Again, as we're going to talk about in a little more detail going forward, the SBA has given some guidance that you can use an alternative period to better tie out when you receive the loan proceeds with your payroll periods. The original guidance was 8 weeks from the time that you received your loan, but with this further guidance, there is some flexibility to tie that covered period to your actual payroll periods to maximize the amount that you spend during that 8-week period. There are some other costs that may be forgiven as well. Interest payments on mortgages on real or personal property, rental obligations, and again, this is one of the things we have a little bit of additional guidance on through the application that's going to include for personal property as well. So things like copier leases and the like. Those have to be pursuant to arrangements that were in place prior to February 15th, 2020. They're making it obviously very difficult to create new obligations that would constitute forgivable expenses. So where you have these types of arrangements in place prior to February 15th, 2020, like mortgages or leases for real property or leases for personal property, those are things that will be includable in the forgivable amounts up to a certain level, as we're going to talk about, the 75-25 split that hopefully everybody is familiar with in terms of payroll costs versus everything else. Utility payments also fall into that 25% bucket, utility and transportation costs. They didn't give a ton of guidance on what transportation costs will constitute, but I think the expectation is that it would include things that would normally be deductible as transportation expenses on tax return in certain circumstances. So things like gas and auto rental, things like that. Next slide, please.
Hey, Mark, before you go to the next slide, I just wanted to mention a couple of things. We have been asked in the process whether the borrower could create some sort of related party obligation to generate forgivable loan payments. And the February 15th, 2020 cutoff date really does stop borrowers from using that type of strategy to create new obligations. I'd also just want to mention that even though debt obligations that were in place as of February 15, 2020 are eligible PPP expenses, those expenses, non-mortgage interest expenses, are not forgivable. So there's a bit of a disconnect between the expenses that qualify as PPP expenses and the expenses that qualify as forgivable expenses.
Fair enough. Those are both good points. And just to put a little bit further clarification on Mark's point, to the extent that you've got rental arrangements in place prior to that February date, where let's say you have a business that operates in one entity and you hold the real estate in the other entity, and you have an arm's length arrangement, a written lease where you've consistently been making rental payments prior to that date, those expenses likely up to that 75-25% split, those expenses will qualify as forgivable. But without that in place, you can't create something now and try to apply it either going forward or retrospectively. So we want to just talk a little bit about the payroll costs. It's a very broad bucket of expenses. It goes beyond. It obviously includes wages, salaries, commissions, things like that. But it does go beyond that, and it includes things like payments for paid leave, payments for severance, your health plan payments, including the insurance premiums, required retirement benefits. All of those sorts of things will fall under the umbrella of payroll costs, which is going to be important when you go to fill out your loan forgiveness application. And it's important to note that those things will get picked up there to take advantage of the forgiveness aspects. Because again, as we're going to discuss, there's a cap on non-payroll expenses of 25%. No more than 25% of the forgivable expenses can come from these non-payroll costs. So you want to push as much as possible into these payroll costs to make sure that you've got a big enough percentage of your PPP loan proceeds being used to qualify you for the maximum amount of forgiveness.
Mark, I would just add to your points regarding payroll, another disconnect between eligible expenses and forgivable expenses. And with regard to payroll, you can use payroll to pay all of your employees, even those that earn more than $100,000 a year on an annualized basis. But while you can use the PPP expenses to pay those payroll costs, only payroll costs up to $100,000 per employee are forgivable.
Correct, and that's correct. And we'll see that on the next slide, please, where we don't include any of those costs above 100,000. And again, just to clarify Mark's point, you can pay them. You can use the loan proceeds to pay them. It's just that those amounts are not going to be. You can't include those amounts over 100,000 when you're making your application for forgiveness. And then the other point, again, that we just want to really stress, and hopefully anybody who's taken out a loan at this point is familiar with these concepts, but at least, or up to, let me rephrase that, at least 75% needs to fall under the bucket of payroll costs. If you're planning on using your PPP loan to cover a lot of, let's say, real and personal property rental expenses, that's fine, but only a small piece of that is likely going to be forgiven. So, next slide, please. So this is some of the guidance that was generated in connection with the PPP loan forgiveness form. When the original CARES Act language came out, it said costs incurred and payments made. And the "and" was causing a great deal of angst because, as we all know, I mean, the payroll periods don't match. Sometimes the other rental payments aren't going to match up perfectly with the timing. So the forgivable costs changed to costs incurred or payments made on the payroll side was very helpful and will give some flexibility to employers in terms of determining which period, whether they want to use the 8 weeks after they receive the loan or the alternative period to tie it out with payroll periods in terms of calculating the forgiveness amount.
Mark, I would just add to that comment that one question we've been asked by a lot of people is, can you accelerate future payments into the covered payment period by paying them during the covered payment period? And the answer is we don't think so, because generally on the cash, generally it has to be paid or incurred, and a future payment of rent or a mortgage interest prepayment or compensation that has not yet been incurred wouldn't be eligible under this costs incurred or payments made requirement. But I would also say, you know, things like bonuses paid in the normal course of businesses and hazard pay that are paid during the covered period likely would qualify as eligible payment expenses for purposes of this costs incurred or payments made.
That's right, Mark. And again, you have to be mindful of the $100,000 limit if you're talking about doing bonuses to employees, but there are some employers that are offering frontline workers some type of bonus to compensate them for, you know, staying involved, for showing up for work every day. And those, from everything we've seen, those are going to be includable, again, up to the $100,000 limit. Those are going to be includable in the forgivable costs. But you can't prepay, you can't generate some expenses. You can't have your landlord accelerate your rent or anything like that in order to prepay it. Those will not be permitted.
I'd also just want to add that it's unclear if you can pay expenses that are owed for a period prior to the covered forgiveness period, whether you can accelerate them into the covered forgiveness period. For example, you pay your March wages to your employees after receiving the PPP funds in April, whether that payment qualifies as a payroll cost because it was paid within, it was certainly incurred in March and paid within the covered forgiveness period. What's unclear is how aggressive you can be with that. How far back can you go in moving payments that have been incurred for prior periods into the covered forgiveness period?
Yep, agreed. Next slide, please. So generally, if you use all of your PPP funds for payroll costs during the covered period, the full amount is going to be forgiven. The amount that is forgiven is reduced by a couple of things. On the payroll side, it's reduced by any reductions in employee headcount. And again, we'll talk in more detail on the application piece, that there are some makeup provisions here, but it's reduced generally by any employee cuts in headcount, or if you reduce employees' salaries or wages below a certain level during the covered period. Any of those reductions are going to cause a reduction in your forgiveness amount, subject to the, we'll call it recapture provisions that they've allowed. Next slide, please. So as we're gonna talk about on the application piece, there's the number of employees is going to be pegged to this term full-time equivalents, and they've provided a mechanism for calculating the number of full-time equivalents. And as you can see, it's a straight mathematical exercise whereby you're comparing the number of full-time equivalents during the covered period to the number of full-time equivalents, either, and it's the borrower's choice, either for the 2 months, for January and February of this year, or the average number between February and June of last year, 2019. Obviously, you want to do your calculations and take whatever of those two numbers is the lowest and use that as your denominator whenever you had fewer full-time equivalent employees, whether it's the first 2 months of this year or the period of February 15th to June 30th of last year. But that's how you want to calculate the number of full-time employees that you're using as a comparison, whichever one of those is lower. Let's see. Next slide, please. So here's a very brief example for someone who borrowed $100,000, and for the period for last year they had an average of 100 full-time employees. For this year they had an average of 80 full-time employees. So they're obviously going to use this year as the comparison period. During the covered period, they had to cut their workforce by 20. So, and we're going to assume in our example that they used the full loan amount, the full $100,000 on payroll. So for the comparison period, there were 80 employees. For the covered period, because of layoffs, employees staying home, there were 60 employees. So 60 over 80 gives you a reduction of 25%. You're going to reduce the forgivable amount by 25%. So the maximum amount that can be forgiven at that point is the $75,000. 25% of 100,000 you lose, and so the maximum amount, so again, subject to the recapture, is $75,000. Next slide, please. There is some relief, as I said, if you rehire your workers by June 30th. The guidance on that, there needs to be a little more guidance on that because it's not clear if simply by rehiring them on June 29th you meet that standard. I can't imagine that's what they intended, but that's kind of where we are with the guidance right now. I mean, obviously that's a risky approach, but we need some more guidance on that point.
Mark, I would just add to that that relief applies even if the February 15th number of employees is less than the number of employees you had using one of the look-back periods, the 2019 or 2020 look-back periods. The idea is that even if you can't get your employees up to the employee count that you had during the look-back period, if you can get them up to the number, if you can get yourself up to the number of employees, I'll call it for the at the start of the COVID-19 period, that's going to provide you with relief under this exception.
Yep. And the SBA and Treasury, if we could go to the next slide, please. One question that everybody had been raising was what happens if you have an employee, you've let them go and you've tried to bring them back, but they don't want to come back. How is that going to work out on your forgiveness application? Are you going to be penalized for that? And the answer is no. The Treasury and SBA have given some guidance in the form of a response to a frequently asked question. This one's numbered 40, frequently asked question 40. And they've provided that to the extent that you have an employee who's been let go, you make an offer to rehire that employee at the same wages and at the same number of hours. That's important. But if you make that offer to rehire that employee and the employee declines the offer, then you're not going to be penalized for forgiveness purposes. That number is going to come out of, that employee will in effect come out of the denominator and is not going to cause you a penalty for that. Now they haven't given a ton of guidance as to how much you can modify that offer. So for example, what if you only offered the employee 75% of the salary or a reduced number of hours? They've not specifically said that you can't get the benefit of the offer of rehire. Hopefully there will be some further guidance on that point, because I think a lot of folks, including some of the Congress people who are advocating for some of the changes to the PPP program, are recognizing that it's not really going to be possible to bring people back at their full salary or their full hours in any number of businesses because of where we are right now. So,
Mark, I would just add to your point that while the employee who declines the offer is treated as a full-time equivalent employee for purposes of the full-time equivalent employee calculation, you don't get to count their salary as being paid with PPP funds. So you need to make up their salary in terms of payroll to get to the 75% necessary to qualify for forgiveness.
Yep, that's an excellent point. That it won't hurt you on the full-time employee test, but it will hurt you on the well, actually I take that back. It won't it won't hurt you on the full-time employee test, but you need to deploy that money elsewhere in order to get forgiveness for it. It's not as though you can still seek forgiveness. Let's say they were making $80,000 a year. You need to deploy that $80,000 to pay some other salary or costs in order to seek forgiveness for it. Next slide, please. And again, this is what we spoke about a little bit earlier about the salary reduction. If you reduce an employee's salary by more than 25%, that is when you're going to start to see a dollar for dollar reduction in the amount of the forgiveness that you can recover. If you have an employee who's making $100,000 a year, you cut their salary in half. If you cut their salary by $50,000, you're going to see a $25,000 reduction, because that's the amount that's in excess of the 25% reduction that you are allowed. And there's a makeup provision for that if you restore them prior to June 30th, but the guidance on that is a little bit squishy at this point. So, it's a difficult call in terms of reducing salaries. If you've got the PPP funds available, it may be better to simply pay the full salary, or if you're going to reduce it, not reduce it by more than the 25%, to make sure that you can gain as much of the forgiveness as possible.
Mark, I would just add to your comments, and it really relates to bullet point 2. For purposes of salary reductions, it only applies to employees who didn't receive during any single pay period in 2019 a salary or wages at an annualized rate of pay over $100,000. And another way of saying it is a possible reduction in loan forgiveness applies only to employees who make less than $100,000 for all pay periods in 2019. And what I believe is still not clear is how strict this limitation is going to apply. And the example would be, what if an employee makes a salary of $80,000 in 2019, but receives a bonus of $5,000 during 1 2-week period? Well, if you looked at just that 1 2-week period, the employee's annualized salary for that 2-week period would be in excess of $100,000, even though the employee really only received $85,000 in compensation for the whole year. And the question is that employee not subject to the salary reduction calculation, because for that one pay period, if annualized, that employee would have made over $100,000. But
Yep.
That would seem to be the result under the definition of employee.
Yep. Agreed. Next slide, please. So this is just an example, as we had done before. We did an example of how the reduction in the forgiveness amount would work with the reduction in headcount. This is an example of how a reduction in forgiveness would work if there's a reduction in salaries. Again, we're going to assume a $500,000 loan with all of it going to payroll costs. And again, to Mark's point, let's assume that all the employees are making less than $100,000 and their total comp at February 15th is $300,000. If you reduce everybody's salary by 40%, you're going to take the 25% buffer, if you will, 15%. You're above that by 15%. So you're going to reduce the maximum forgiveness amount by 15% of the payroll costs, which is going to knock your forgiveness down by $45,000, 300,000 times the 15%. So assuming everything else is used for forgivable costs, the maximum you would be able to receive forgiveness for is $455 out of that $500,000 loan because of the reduction in salaries. So again, any of these reductions in both salaries and headcounts, you want to think them through very carefully because they are going to reduce in many circumstances, certainly in the headcount, and then in the salaries, anything above 25% for the folks under 100,000 a year. These are going to reduce the amounts of forgiveness that you can recover. And then again, if we could, as we'll see on the next slide, there is some relief available to people who restore the salary and wage reductions by June 30th. Again, it's not clear if this is something that you can do on June 29th and then receive the benefit of the restoration. The guidance is just not clear on that, and there are some commentators who are taking a very aggressive approach on that. But I think we would hope to see some more guidance from the SBA and from Treasury between now and when people will start filing their forgiveness applications in order to make that point clearer as to how you can get the benefit of the restoration.
Yeah, I would just also add, this is Mark Feiner, that based on this exception, it seems that the SBA is going to ignore reductions in salary during the covered period relative to the first quarter of 2020, assuming that's the quarter that we're looking at for comparison, if the salary is restored to at least what it was on February 15, 2020 by that June 30, 2020 end date. Next slide, please. So now we're going to, this is Mark Feiner again. Now we're going to talk about how to request PPP loan forgiveness. And as many of you may know, the PPP loan, next slide please, the PPP loan application, forgiveness application was issued on May 15th, 2020. And if you do a simple Google search or go to the SBA website, you should be able to find it. And as Mark talked about before, something new in the application is this alternative covered payroll period. And to be clear, this alternative period only applies to payroll. And essentially what it allows borrowers to do is that borrowers with at least a biweekly, if not more frequent payroll schedule can elect to calculate their eligible payroll costs using the 8-week period that begins on the first day, the first pay period following the PPP loan disbursement. And this better aligns, allows for better alignment with pay periods. So for example, if a borrower received a PPP loan on Monday, April 20th, and the first day the pay period following receipt of the loan was Sunday, April 26th, for purposes of calculating eligible payroll, the first day of this alternative covered period would be April 26th, and the last day of the alternative covered payroll period would be Saturday, June 20th, rather than what otherwise would have been June 14th. The application requires borrowers who, along with affiliates, receive a PPP loan in excess of $2 million to check a box. And it expands that FAQ 40 exemption for loan forgiveness reductions based on an offer to rehire somebody at the same salary and the same hours, and that employer refuses. That exemption also now includes employees who were fired for cause, who voluntarily resign, who voluntarily request and receive a reduction in their hours, and that these exceptions only apply if the position isn't filled by a new employee. And another thing that the application makes clear is that non-cash compensation to owners is excluded. So in effect, owner-related health insurance, retirement benefits, and employer-paid state and local unemployment compensation are excluded from the definition of payroll costs for business owners. Next slide, please. Something Mark talked about earlier, the CARES Act and the guidance that was issued following the enactment of the CARES Act didn't define what full-time equivalent employee was for purposes of the forgiveness computation. And you'll see when you look at the application, you determine the number of full-time employees based on hours. And you look at the average hours worked per week by an employee divided by 40 and round to the nearest tenth, so that the maximum amount for each employee, whether they work 40 hours or more than 40 hours, is 1. And everybody else, you divide the number by 40 if they work less than 40 hours. The application also provides for a simplified method of FTE calculations, whereby 1 is used for every employee who worked 40 hours a week or more, and 0.5 is used for every employee that didn't meet the 40-hour requirement. And just to be, it's important to note that employers or owners are not included in the calculation. And you'll see just from the simple example, using the FTE calculation, you come out with a denominator of 3.2. And under the simplified method, you come out with a denominator of 3 for purposes of the reduction in FTE calculation. And you'd want to use the simplified method in this example, because the small denominator will result in a larger percentage multiplied against the maximum forgiveness amount. Next slide. One thing the application also made clear is that, as we previously talked about, all eligible wages or self-employed income are limited to an annualized amount of $100,000 for purposes of computing PPP forgiveness. And the application adds another limitation specific to owners. An owner's compensation included in payroll costs can exceed the lesser of $15,385 or the 8-week equivalent of their 2019 compensation. And the $15,385 is used because $15,385 compensation over 8 weeks equals annualized compensation of $100,000.
Yeah, and if I could just jump in, Mark, we had received a question prior to the presentation asking about that and whether or not owners' compensation was forgivable in the PPP amounts, and that is the analysis right there that you would go through for that owner's compensation. It's unfortunate that that's how they decided to cap it, but that's where we are right now. Again, there may be some future guidance on that point, but as of right now, that is the limit for compensation to a self-employed owner.
That's a great point, Mark. Next slide, please. So one thing the forgiveness application gave us was an ordering rule that borrowers should follow to compute the loan forgiveness amount. And there was no priority listed in the CARES Act or the interim guidance relative to the order in which forgiveness limitations were applied. And the forgiveness application provides that a borrower is required to, 1, take the sum of the PPP costs, adjust for the salary hourly wage reduction, then apply the full-time equivalent employee reduction ratio, compare the total PPP loan amount to the modified total, and determine the maximum loan amount based on the SBA requirement that at least 75% of the loan forgiveness amount must be attributable to eligible payroll costs. And one simplified way of doing that is you look at your payroll costs, you divide by 75% to get potentially the maximum loan amount, and the difference between the maximum loan amount and that 75% payroll cost would be non-payroll costs that are eligible for forgiveness. The application requires a significant amount of data collection and documentation requirements, and the volume of data to be analyzed and documentation required to be submitted to evidence the actual payment of qualifying expenses is significant. For mortgage interest, you'll see it's lender amortization schedules, canceled checks or receipts, lender account statements for rent and lease payments, It's copies of current lease agreements, canceled check or receipts, and lesser account statements. And for utility payments, copies of invoices, canceled checks or receipts, or account statements. And one very important suggestion that we have made to all of our clients in the process is we've recommended that the clients open a separate bank account to deposit the PPP funds so that tracking can be used to associate the payments made from that segregated PPP account to the payroll costs as well as these other non-payroll costs.
Yeah, and one item to note on the payroll costs, at least initially, based on the instructions to the form, Mark, they're requiring that there be, to document the payroll, they're requiring certain tax forms.
Yep.
And those tax forms include the 941s, the payroll tax filings for the IRS and the state. And that may cause some issues for when you can apply for forgiveness, because if you use the alternative period, right, if you start your covered period later to coincide with a payroll period and your covered period runs into July, you may have to wait until the end of Q3 when you get those payroll tax forms at the end of Q3 to actually make your application for forgiveness.
Next slide, please. So in addition to all of the documents you have to provide to the lender, there's also a 6-year record keeping requirement. And there's a laundry list of documents that have to be kept for the 6 years. Employee payroll and hours information, job offers and refusals, firings for cause, resignations, documentation supporting the full-time equivalent employee reduction safe harbor, and all the document relating to the PPP loan that were submitted as part of the applications regarding the certifications, documents supporting the forgiveness application, and documentation demonstrating compliance with the PPP requirements. And what's also new is, or maybe not so new, is frustration over this whole process, because the guidance that has been spilling out over the course of time is constantly changing. The application provides new guidance, and in many cases, that's too little too late for many borrowers who are already through a significant portion of the covered forgiveness period. I would mention briefly that there is some proposed legislation either in the HEROES Act or other legislation like the Paycheck Protection Flexibility Act that would allow borrowers more time to use the PPP proceeds. It's been suggested 24 weeks or December 31st of this year, whichever comes first, eliminating the 25% limit on non-payroll costs, because for many borrowers, non-payroll costs is a significant portion of their business expenses. Would move the maturity date of the PPP loans to 5 years from 2, and would permit PPP qualifying expenses to be tax deductible. Next slide. Mark, this is you.
Yep. So I want to talk a little bit here about look, this is going to affect everybody who got one of these loans, whether you're under 2 million or over 2 million. The guidance on this has been very much back and forth. When the PPP loans were first announced, they said we're waiving the usual SBA requirement that you exhaust a search for other sources of debt or capital. So everybody thought, okay, this is great. It's an easier application process. Then they came out with FAQ 31, which said that everybody has to certify that they have the economic need because of the situation, that they need this money. That gave a lot of people pause. They came out with FAQ 39, which indicated, they announced that anybody who received over 2 million was likely or could be subject to an audit. They say they're going to review all of them. I have no idea how in practicality. They're still trying to figure out how they're going to process our 2019 tax returns. I don't know how they're going to review every loan over 2 million. And then they sort of settled everybody's nerves, got everybody calmed down that's under 2 million with FAQ 46, which basically said if you're under $2 million, they're going to treat you as having made that certification in good faith. So you kind of don't have to worry about it. They said there may be spot checks, but again, I don't know what the likelihood of that is. So there's a real split here between loans under 2 million and loans over 2 million in terms of what the possible outcomes are in terms of audits versus not being audited. But I think in all cases, you would do well to make sure that you have good documentation for both the economic need for the loan and when you apply for the forgiveness. This documentation should probably take the form of board votes, board votes that authorize the officer of the company both to seek the loan and to apply for forgiveness. As we'll see on the next slide, it's important that you document that economic uncertainty. Again, either way, whether you're over or under 2 million, this is important stuff that you should have in your corporate records. And there are a lot of things that really go into that economic uncertainty. And sometimes, some people focus on them, some people don't. But there's a lot of uncertainty about when businesses are going to reopen. There's a lot of uncertainty about whether or not there's going to be a vaccine or whether or not there's going to be a second wave. And is that going to keep crowds down? How is it affecting your supply chain? How is it affecting your customers? Are your customers likely, going to be impacted to the point where they can't pay their bills to you? So there's a significant amount of analysis that needs to go in here to document your economic need, as well as whatever reasons alternative sources of liquidity aren't available. It's not a great borrowing market right now. It's tough for the banks to analyze loans, and I'm sure we have some lenders on here, and I do sympathize. It's tough for them to analyze loans because they don't have any more insight into where businesses are going than we do. Anyone else on the call. There's no crystal ball that's going to allow bankers or lenders or investors to say, well, that's going to improve in 6 months or a year, so I'm going to make some loans or I'm going to invest some money. It's really as simple as trying to make a search for alternative sources and just documenting the inability to do so. But I would recommend for anyone out there that's done a PPP loan, get some documentation into your corporate records regarding the economic necessity, regarding the approval to authorize an officer to apply for the loan, and then regarding the approval authorizing an officer to apply for forgiveness.
Next slide.
Next slide, please.
So, Mark, I think we should do these slides and maybe how to prepare for the audit process, given the small amount of time we have left.
Sure.
With regard to the submission package, you're going to need to provide the lender with all the calculations and materials supporting the qualifying expenses. And for example, payroll, you're going to want to have documentation showing cash compensation, payroll tax filings in the form of Forms 941, state business and individual wage reporting, unemployment insurance tax filings, documents showing employer contributions to employee health and retirement plans, documents prepared in support of the decision to keep the PPP funds, like that economic necessity, documentation which tracks qualifying expenses, which is the reason we recommend that qualifying expenses be paid from a segregated account, and then assemble all the documentation relating to specific expenditures, leases for lease payments, utility bills, mortgage interest invoices, payroll records, etc. You're going to need to show calculations regarding full-time equivalent employees, headcount changes, and since the lender is the final arbiter on whether forgiveness, the amount of forgiveness the borrower is eligible for, you're going to want to follow any lender instructions and requirements. And no later than 60 days after the date on which the lender receives the application for loan forgiveness, the lender has to issue a decision on that application, and we'll see whether that 60-day period is broadened to, 75 or 90 or whatever, based on the number of forgiveness applications, which I'm sure banks are going to be inundated with. You want to move to slide 30?
Yep. So yeah, as I mentioned earlier, don't wait until the last minute to get board minutes, board analysis, any analysis done by officers or high-level employees about the uncertainty surrounding the business. Get those done, get them in the file so you're not scrambling to pull them together. If you do get a notice that you're going to be inspected, as Mark pointed out, we've been strongly recommending to people to create segregated accounts, create a double ledger, not for anything inappropriate, but just to have a separate ledger account that tracks the loan payments in and the loan payments out, specifically where they went. If you're over 2 million, you've got to put a little bit of extra effort making sure that your good faith economic necessity certification, how you arrived at that. It's not a bad idea to have one of your advisors, whether it's your law firm, accounting firm, somebody like that, do a mock audit, do an internal audit, and press very hard, as the government would, to see where the gaps are, to see where there are any holes with respect to your documentation. And again, you can't be too meticulous in keeping records when it comes to this. This is a whole new world. It's a program that was thrown together very quickly, a lot of good, some bad. We don't know what it's going to look like on the back end, so your record keeping can't be too meticulous here. Next slide, please. Again, and this is particularly important if you're over 2 million on the size of the loan. Spend some time, ask some hard questions, dealing with the economic necessity and the good faith certification, confirming that you needed the loan and that the loan was used for appropriate purposes, that you're not going to be, I think a few people have asked this question. I think it's pretty well settled by now. You can't double dip under the PPP. You can't take out a loan, decide you need more money, and then go to another lender and take out a loan. I have no doubt, given the speed with which this was thrown together, that some of those double applications would get through. You're supposed to be assigned an SBA number as part of the loan, but I wouldn't be surprised if, given the rush to approve these loans, that multiple approvals could happen, but that is strictly forbidden. So again, these are some of the things as you go through and review and do a self-check you want to confirm.
I think we can go. We're just about ready to wrap up. You'll see the next few slides are simply showing you the penalties that a borrower is potentially subject to by not following the PPP requirements. And then the last slide is just showing you that the Department of Justice does mean business. They have already brought charges against 4 borrowers for submitting fraudulent PPP applications, either making up the number of employees or making up fictitious businesses. So it's just something to be aware of, that even though the number of audits may be small, particularly with people with loans in not in excess of $2 million, it is very important to have all your ducks in a row when you do apply for the forgiveness.
if you are going to create fake employees like one of these borrowers did, use a little more creativity with the names and don't go with, Amanda Hug and Kiss or some of these fake names that we see the governor of Mississippi reading off on his graduation announcement. So
Yeah. Well, thank you everybody for attending this webinar. And if you have any questions, there's a slide with my information and Mark Tarala's information. So feel free to reach out to us with any questions that we didn't address on the webinar. And
yeah,
thank you everybody. Stay safe and be healthy.
thank you, everyone.
Bye-bye. Hello?